Today I am going to explain about the chapter Financial Management, and here I am only explaining the important concepts of Financial Management chapter. The first of all, let us know what is Financial Management. It refers to efficient and effective acquirement and usage of business finance. So financial management refers as the effective and efficient acquirement. So first of all, let us know what is efficient and effective. As a business studies today, you know what is effective and efficient. It means with the minimum effort, maximum output. So with the minimum cost, the financial management aims its maximum output. Now the next term here is business finance. It refers the money required for carrying out business activities. You know what is finance. Finance means money or funds. Business requires funds for its activities. Suppose you want to start a business organization. How is it possible? You need money. So this management of this money, and why this money? To purchase assets which are necessary for carrying out the business activities. So the management, the procurement means collect or mobilize or gather these things and its efficient usage. The sources which are gathered should be utilized properly. So this management is the means efficient and effective usage of procurement and usage of business finance. And finance means money required for the business activity. And now let us see the next important concept, the role of financial management. The role of financial management. Why management? Why financial management? Money is the lifeblood of commerce, and managing this money is the key factor for the successful of a business. And the role of financial management lies the manage the finance effectively and efficiently. So in order to manage it effectively and efficiently, he has to fix the size and the composition of fixed assets. For example, suppose you want to start a business. You have 10 lakh rupees with you. The firm is having 10 lakhs rupees. Imagine that with the 10 lakh rupees, the business purchased the assets with this full 10 lakh rupees. What happens? Will they be able to move on? No. Why? Because the whole amount is invested in fixed assets. So he has to decide. There lies the importance of the financial management, that he has to fix the proportion of how much of this 10 lakhs, how this 10 lakhs should be utilized. This 10 lakhs can be utilized for different types of assets so that he can continue the business. For that, he has to decide the quantum of current assets and its breakup into cash, inventories and receivables. This 10 lakh rupees can be utilized proportionally. 7 lakhs can be utilized for purchasing the fixed assets. The remaining 3 can be used for managing the current assets. Then the question is, what is fixed assets and what is current assets? You know what is, as a commerce student, you know what is fixed assets. The assets which are of long life, and current assets means to manage the business they need some assets, they are inventories, receivables, etc. to manage. So the role of management, the importance of or the role of management, financial management is that fix the size and composition of fixed asset. How much amount is to be invested? You have only 10 lakhs rupees, out of which how much you will invested in the fixed assets, how much will you invested in the current assets. The management of this fixed assets is also called capital budgeting decisions, that you will learn later. Capital budgeting, and this is called management of current. This is called working capital management. Now the next topic is objectives of financial management. Let us see what is the objective of financial management. Objective of every financial manager or the management is to increase the wealth of the shareholders. How it is possible? How can the value of the shares increases? Then we can say that the wealth of the shareholders increases. So, the wealth maximization means increase the share market value of the shares in the stock market. So that for that, what to do? The profit or the firm will be able to give a more amount, a higher amount as its dividend. If dividend is given, normally the demand for the product, demand for the share will increase. And this helps the business firms to increase the market value of the shares, and naturally it increases the wealth of owners. So how this market value can be increased? For that, the managers has to take certain financial decisions. Let us see what are the major financial decisions taken by the finance manager. Important financial decisions taken by a finance manager. They are categorized into three. That is investment decisions, financing decisions and dividend decisions. Let us see one by one. Investment decisions. Investment decisions related to the management of fixed assets and the current assets. How much? Earlier I told that the objective of financial management, the role of financial management is that fix the components of fixed assets and the quantum of current assets. This is the extension of the same point that investment decisions. He has to decide as to fixed assets, what all fixed assets are required. Suppose you are going to start a mobile manufacturing unit, mobile phones manufacturing unit. For that, what all assets are required? You need land, building, machinery, material, etc. And here you have to decide what are the fixed assets required. This management of fixed assets is otherwise called a capital budgeting, and lot of factors are influenced by these decisions. And the current assets, management of current assets are otherwise known as working capital management. So here he is deciding as to the fixed assets required and the money required for the money of or the total value of the fixed assets and its proportion. Fixed assets, there are different assets, maybe the land, building, machinery, plant, etc. So if the whole amount is invested, again I told earlier that if the whole amount is invested in one part, they cannot continue the business activities. And for that, he has to decide as to the proportion of fixed asset as well as the quantum of fixed asset. The decisions relating to the fixed assets are called the investment decisions. Now we move on to the next important decisions, financing decision. Finance means money, that we know. So here the in investment decisions we have decided that the assets required, the amount of money required for the purchase of fixed assets as well as managing the current assets. So from where will they get the money? That is discussed in this financing decisions. That is the selection of sources of fund. There are two alternatives available to finance manager, that are owner's fund and borrowed fund. Either he has to use his own money, this means the firm's own money, that is share capital, reserves and surplus, or the other alternative is to he can go for the borrower's fund. Examples of that, long-term loans and debentures. So which one he has to choose? For that, he has also considered a lot of factors that we discuss later. The factors to be considered while the selection of this finance. So finance is related to money, and here in order to increase the market value of the equity shares, he has to decide this options. He has to decide the sources from which will he get the money. I am repeating that the owner's fund and the borrowers, he has to choose. or either he can choose owner's fund or borrower's fund. But normally what finance managers are doing is a combination of both of these two, equity and the borrowing. The equity and debt can be combined, and these decisions are known as financing decisions. Now I am moving to the third important one. This is also very important in order to increase the market value of the equity shares. They are dividend decisions. This the decision is relating to the appropriations of the profit earned by the firm. That is, how much to invest for future activities and how much to distribute as dividend to equity shareholders. So here he has to decide the profit, whether he will retain some part of it or he will distribute the whole amount. Is it wise enough? Is it wise to distribute the whole amount of profit as dividend? No, not at all. It is not an easy one, because they want to continue its activities. For the continuance of the business, they need, that means for the growth, they have to retain, they need money, and for that they have to retain some part of the profit earned as investment for the future activities. And the next he has to decide as to how much is to be distributed as dividend. Remember, the shareholders always aims at increasing their rate of dividend. They are always happy with this increasing rate of dividend. But is it affordable from the point of view of the company? No, it's not possible, because to survive and to grow, they need funds, and these funds, so he has to take an appropriate decisions regarding how much to retain, how much to distribute as a dividend. And for these activities, some many factors are to be considered that we will discuss later. Now let us see what are the factors affecting the investment decisions. The first one, cash flows of the project. How much money is required to purchase a particular asset? If assets of same category, two brands are available, A and B brands are there. What is the money for this price? For example, the machine A costs 5 lakh rupees and machine B costs 3 lakhs rupees. So here the cash flows from this, we could easily ascertain that 3 is busted as it is a lost amount. But the outflow, that means we invested 3 lakh, how much we will get? This we have to, that means the efficiency or the efficiency of this machines has to be analyzed. This, if we invest 5 lakh, it will be able to produce 1000 units, and the B is only 200 units. Now consider the outputs of these two, 1000 and 200. So naturally, if we compare the price, 100 is the 100, then we will get 1 lakh rupees, and here it is only 20,000 rupees. That means if we invest 3 lakhs, we will get only 20,000. But if we invest rupees 5 lakh, we will get 1 lakh of rupees. So this, that means they are generating a cash flow into the business. This capacity has to be evaluated. Then next is the rate of return. That is the same way. The rate of return means the rate at which the firm is gaining some amount. The return on the investment is higher the rate, better it is. Then investment required. If the more amount is required, then we will go for the less one. But at the same time, we should see the cash flows of the project. Is it helpful in generating the cash flow? We will go for the more generating projects. Then the availability of funds. If the funds are available, if you have two options are there in order to purchase the same brand, same machines, a machine A and B. The examples are 10 lakhs rupees, and here it is 3 lakhs rupees. Now, normally if we have less funds, we will go for the 3 lakh one. If we have more funds, We will go for the 10 lakhs machine. So the availability of funds with the firm is also another important factor in the investment decisions. Then next is the rate of interest and the risk involved. So here the risk involved on these assets are to be evaluated. Higher risk, that means more profit. If they have more funds, they will go for it. So these are the factors which are to be considered while taking investment decisions. Now let us see the factors affecting the finance decisions. Financing decision is related to the decisions relating to the debt or equity, either debt or equity or a combination of these two. This is decided by the considering these factors. The first of which is cost. The cost of getting a debt. Debt means borrower's fund. Examples is debenture or a long-term loan. In order to get a long-term loan or for the issue of debentures, what is the cost involved? This has to be considered. And next is the equity. Equity means owner's funds. And for fresh issue of equity shares requires more money. So compare it whether to use the equity or the debt. If the cost factor is involved, debt means it's highly compared to equity, it's more costly. So if they have enough money, they can go for the debt. Otherwise, the equity is good. Then the next factor is risk involved. Now consider the debts are there. The company issues 10% debentures of rupees 100 each for an amount of 10 lakhs rupees. So every year they have to pay interest at the rate of 10%, that is 1 lakh rupees. Every year they have to pay as debenture interest. This is the risk factor. So see that the firm is able to pay the interest regularly, and at the end of the stipulated period will they be able to pay back the money to the debenture holders. This has to be considered. But as in case of loans also, loans requires repayment. Repayment means the principal amount plus interest is to be paid. So whether the firm is able to pay the installment of interest. It includes the principal as well as the interest part. That means this is the risk. If they are unable to pay this, they have to face some legal consequences. The debenture holders as well as the borrowers will go for the court, and um, they have to face lot of difficulties. So whether in order to go for the debt or equity, and compared to from this point of view, equity is cheaper because there is less involved. Once the equity capital is received, there is no need to give any interest. If dividend is payable, but when it is payable only when the firm earns sufficient profits. So in times of profit alone, there is a need for paying dividend. But in case of debt, they must, it's compulsory. That they have to pay the interest. So the question is whether the firm is able to pay the interest regularly. So the risk is high in case of debt, and risk is less in case of equity. So this has to be decided by the finance manager whether they have to assume a high risk or a low risk. If they are ready to assume high risk, they can go for the debentures. Otherwise, they can go for the equity. Then next is flotation cost. Here again, the flotation cost means the money required for the raising of these funds. Suppose the firm is going for debentures or loan or debentures, then needs less amount compared to equity shares, because in order to issue of equity shares requires a lot of legal formalities are there. Legal formalities that they have to file application, file the prospectus, preparation of memorandum and articles of association. Many legal formalities are there, and it will also take lot of time. So, but compared to equity, the loan, getting a loan or issuing a debenture is easiest way. So the flotation cost in case of equity is high, whereas the debt is low. So if they have enough funds, they can go for debt, or the flotation cost. Compare this, they will go for the less flotation cost, they go for the equity. Now the next is level of fixed operating cost. As I said earlier that the debentures or the debt requires a fixed payment of interest. Fixed interest has to be paid. So the fixed operating cost is high in case of debentures, and whereas in case of equity it is very less. So then this has to be considered before fixing its debt or equity in the total financing decisions. Then state of capital market. If they decided to go for the equity or the debentures, whatever be it is, they should see the prevailing market conditions, whether it is suitable for the equity shareholders, the preference shares or equity shares, whatever be it is, if the stock market activities, the stock market atmosphere is favorable, we can go for the equity, otherwise debt is a better source. So these are the important factors affecting the finance decisions. Now let us see the factors affecting the dividend decisions. So dividend decisions, here the managers has to decide how much to retain and how much to distribute as dividend. This is the area that a finance manager has to decide, that how much out of the total profit earned by the firm, how much to retain for future activities and how much to distribute as dividend. So the retainment of the profit or the distribution, he has to consider the following factors. The first of which is earnings of the company. If the earnings of the company are high, they can distribute high rate of dividend. If the earnings of the companies are low, their rate of dividend will be low, or sometimes the firm may not be able to pay out the dividend also. So then next is the growth opportunities. Growth means development of the business. They have to purchase new machines or to build a new plant. That means they are increasing their business activities. The volume and the quantity of the activities has to be increased in abundant. For that they requires money. So from the profit earned, how much to retain? If they want the growth opportunities, they want to exploit the growth opportunities, they will retain a good amount of profit, and the remaining, a smaller amount will be distributed as a dividend. So the question here is, what is the rate of dividend? If the company is looking for growth, the rate of dividend declared will be low, whereas the company is not recent time they have no growth plans or development plans, they will go for higher dividend. Then next is cash flow position. If the firm is able to generate more cash, so once the dividend is declared, they will be able to pay the dividends because their cash generating capacity is high. If the cash generating capacity is low, there will be less rate of dividend will be distributed to the shareholders. So here also they will consider how much to retain. If their cash generating capacity is less, the distribution of profit will be distribution of profit as dividend will be less. Then shareholders preference. Shareholders of the company may have different categories, from higher income group, middle income group or lower income group. Middle and lower income group are always expecting a regular income. So they always expect a moderate rate of dividend every year, but they need some income. So in case the shareholders are more in these two categories, middle income and the lower income group, they will declare a higher rate of dividend. But consider the case of higher income group. They are not interested in the regular income. They are interested in the wealth maximization. That means increase in the market value of the shares. To increase the market value of the shares in the stock market, the firm has to declare higher rate of dividend. So higher rate of dividend when at the time of crisis. So this case, if the shareholders prefer a higher rate of dividend, they will declare a higher rate. That means the preferences of the shareholders should be considered while arriving at a dividend distribution. How much to distribute, a higher rate or a lower rate of dividend. Then taxation policy. The taxation policy is also an important factor in influencing the dividend decisions. High rate of dividend means, high rate of tax means less tax, less dividend and vice versa. The next important topic is financial planning. Planning, what you know what is planning, you all know what is planning, that is deciding in advance what is to be done in future. Here as it is related to the finance or financial management, is financial management. Here financial planning implies it's the preparation of financial blueprint of the organization for its future activities. They are preparing for the future activities, how much money is required, when and in what quantity it is required. This has to be decided. This has to be decided well in advance. So it is nothing but the blueprint, financial blueprint of future activities of the organization. And the objective, the twin objective of financial planning is the ensure availability of funds whenever it is required, and see that the firm does not raise resources unnecessarily. That is, ensure availability. Enough fund is required. For example, in order to start a new project, they requires 1 crore of rupees. And the options are debt or equity. You know that is debt and equity. So whether they are going for a debt and the borrower is ready to offer you 2 crores of rupees. 2 crores of rupees, you are demanding only 1 crore, but he is ready to offer it at a lower interest 2 crores of rupees. Now the question is, will the financial manager go for the 2 crore fund? No, a wise or a prudent finance manager will not go for, because they requires only 1 crore. If they are raising 2 crores of rupees means the 1 crore, the remaining 1 crore remains idle in the business, and for that idle activities, they have to pay the interest. That will be a financial burden to the organization. So the decision of the financial manager has to decide whether enough funds are available to the firm in right time. Whenever it is required, it should be available in right time. See, their firm does not raise the resources unnecessarily. That is capital structure. Capital structure refers to the proportion of debt and equity in the total capital of the firm. Suppose the capital of a firm that the firm decides to fix at 10 crores of rupees. And how this 10 crores comes to the business? Is it by way of borrowed funds or by way of equity capital? This has to, the proportion has to be decided by the finance manager. So this is called the capital structure. Here in this example, the total capital of the firm is 10 crores. So out of the 10 crores, how much is debt and how much is to equity? This has to be decided by the finance manager. The proportion in which he arrives is the capital structure. If we can draw it in a diagram, this is the total capital of the firm. Out of this 10 crores, out of this 3 crores is equity and the remaining 7 crores is debt. So we can say that the capital structure of company is 7 debt and 3 crores of equity. This is the combination of the debt and equity in the total capital of 10 crores. So capital structure explains the proportion of debt and equity in the capital structure, and debt means the borrower's funds, so debenture or long-term loans from financial institutions. So the firm has to decide as to how much debt is to be included in the total capital structure. This has to be affected by many factors that we will learn later. The debt means the borrowed and it includes debentures and the long-term loans from financial institutions, and equity means the owner's funds, that is equity or preference share capital, the reserves and the surplus. All together it's called the owner's fund. So here in this capital structure nothing but the combination of debt and equity in the total capital structure. Now I am concluding here. Thank you.